What's up, guys? Filming this third video in a row. It's a lot, but let me get into it. As bonds part two. This time I'm definitely going in depth on these bonds. So listen, a bond is a debt instrument. So as you know, whenever a company issues a bond, they're issuing their debt out to you, and face value slash par value is paid at maturity. So whenever you buy a bond, whether it's a discount bond or a premium bond, you will get that par value paid at maturity out to you. Coupon rate is the annual interest payment, or if they pay it semi-annually, etc., or they pay it every quarterly. It depends on what the terms and provisions are from the company or whoever is issuing the bond. But just understand that regardless of anything, you will get par value slash face value back at maturity, which is usually $1,000. Zero coupon bonds. They don't pay coupons, obviously zero coupon. They sell at a discount, so they're discount bond too. And they only provide the payment of par value at maturity, which is a pure discount bond. So let's say there's no coupon, so you're like, okay, whatever you earn, the appreciation in between, that's what you earn. No coupon, nothing else. Whatever you have paid at maturity and any appreciation you got from that, that is what you get, nothing else. So T-bonds and T-notes. So T-bonds and T-notes, we know that the T-bonds, T-notes were described in the last video. And I'm sorry, I'm just having a lot of things happen. So T-bonds and T-notes, the 5 to 10 and the 10 plus, the accrued interest equals the annual coupon payment, which is divided by Z, which is usually the number that you're given, times the days since the last coupon payment is divided by a day separating coupon payments. That's a lot to understand, but that's what we use in finance as calculation. But anyways, on that, corporate bonds, convertible bonds, puttable bonds. I want to get into definitions to make it easier, not calculations right now. So corporate bonds have call provisions. That means they can say, oh, let me get the bond back. Callable. They may be repurchased by the issuer at specified call price during call period. So yes, callable bonds have risk on them because once somebody says, hey, I'm issuing this debt, but I can get it back from you at any time. Now, obviously, those things will be issued probably at a higher price as a premium, but at the same time, they get to be called back because it benefits them, not you. And convertible bonds allows the bondholder to exchange bonds for a specified number of common stock shares. We talked about that, I believe, in either common stock or bond video. Puttable bonds, the holder may choose to exchange for par value or extend the bond for a number of given years. And that is an example of a corporation will issue puttable bonds as they believe the investor will not ask for the full bond payment. So they're saying, okay, maybe they're just gonna go ahead and we're gonna extend the par value, exchange for par value, or we're gonna extend the given number of years. And floating rate bonds, which are coupon rates that are periodically reset according to the specified market date, which means the coupon rates adjust to the market values. So floating rates, that means obviously when the rates go up, the coupon goes up, and the rates go down, the coupons go down. So they're floating rate bonds. The rate of that coupon, the interest that you're paid out from that bond is going to fluctuate based upon the rates of the market. So rates go up, coupon goes up, rates go down, coupon goes down. Floating rate bonds. Let's get into the international bonds. We have foreign bonds, where a foreign entity issues bonds denominated in their currency of market country. So USA, they're going to issue bonds denominated in the US dollar. Euro bonds, totally different. Euro bonds are denominated in the currency, usually that of the issuing country, different than that of the market, which the bond is issued. So you're probably asking, okay, what is the difference? So foreign bonds, let's just say foreign bonds, you're obviously going to have Japanese yen, okay? Japan issues their bonds in their yen, in their own currency. Foreign bond. Euro bonds, example, Japanese yen price bond is issued by Toyota in the US market. So think of it as that. It's denominated in the currency of the issuing country, but it's going to be in a different market. So a foreign market. So that's what's called Euro bonds. The innovation in the bond market is that obviously when coupon rates go down for the inverse floaters, it's called inverse floaters. Coupon rates go down, rates go up, rates go down, coupon rate goes up. That's the inverse floater. We have asset-backed bonds, which is income from specified assets used to service that debt. Pay-in-kind bonds. Pay-in-kind, what does that mean? That means that issuers can pay interest in cash or additional bonds. So that means that if you want that interest, from a coupon, then you get it in cash, or hey, they say, hey, here goes some more bonds. So that could be very, very beneficial to you. Catastrophe bonds, I believe I touched on before. Higher coupon rates to investors for taking on risks because if anything bad happens, the issuer doesn't want to pay anybody. So catastrophe bonds. Index bonds are where payments are tied to a general price index or price of a particular commodity. So talked about tips last video, but the payments for index bonds are tied to a general index. So maybe the S&P 500, maybe Vanguard, maybe VU, just depends. So bond pricing, because I'm going to get into yields the next video. So bond pricing, your bond value is the present value of coupons plus the present par value. So T, time, maturity date, R is discount rate. So your yield to maturity, which people pretty much have a lot of hard times understanding yield to maturity, is what you demand as the rate of return, yield or maturity. Now, if the coupon rate is less than yield to maturity, then it sells at a discount. But if the yield to maturity is greater than coupon rate, then it's going to sell at a premium. So the longer the maturity, the greater the discount. The longer the maturity, the greater the discount. Longer maturity, greater discount. Just want you to understand that. So if you're going out 30 years, then you have a greater discount. And then bonds with their risk is that interest rate fluctuation are the primary source of bond risk, because short-term rate fluctuations, long-term rate fluctuations will indeed increase and decrease prices of bonds. The bigger the payment, the less the bond rate will move. And then we're talking about bond prices between coupon dates. So coupon dates. So your invoice price of a bond is a flat price plus accrued interest. Now, we have a whole function for this, but just know that the invoice price is the flat price of that bond plus that accrued interest. The yield to maturity is at the discount rate that makes the present value of bonds payments equal to the price. And if you ever want to find out, whoa, what's my bonds yielding right now? Do your annual coupon divided by the bond price. So let me get back to yield to maturity and price. They have an inverse relationship. So when your coupon rate is greater than the yield to maturity, you have it at a premium. That means you're buying the bond at a premium. Obviously, that means over par is probably gonna be like maybe over $1,000 or 1,100 sometimes, maybe 1,200 sometimes. But if your yield to maturity is greater than the coupon rate, you're getting at a discount below that 1,000, depending on what it is at par. And if coupon rate equals yield to maturity, obviously that equals par. And like I said, the current yield you want to find, get that coupon payment divided by that price. Yield to call, which is another provision of a bond, it means that it's the time the call has until it replaces the maturity. So I'm saying what? So the call price replaces the par value. The premium bonds are at maturity to be called. So it's the yield to call. So a callable bond helps the company / issuer, as I just said, because somebody can issue a bond and say, well, give it back here. We're not going to end up having you have this to maturity. So you have to understand when buying a bond that if you have a callable bond, it's not gonna help you. It helps the people that issue it, the corporations, company, etc. But that's it for this part, guys. I'm getting to bond yields next video, but I hope you guys found this informative and very helpful. So I appreciate you guys watching. Tune in next time.